what really happened? Why did gold rally so strongly and then suddenly dip? And most importantly, what does it mean for South African investors? Stick around. I'm going to be breaking that down in very simple terms. And I'll show you how you can position yourself smartly in the market. Hi, my name is Yolanda. I'm a wealth advisor. It is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. I'm the founder of this platform, Financially Fabulous Females. I am also the founder and director of Solomon Wealth Management. We are a boutique wealth management firm based in Durban, and we help South Africans all across the country get their money right. From investments, retirement planning, estate planning, life insurance, we help you figure it all out. Whether you're a South African based here in South Africa, anywhere in the country, or a South African expat that's looking for expert financial advice, I am happy to help you out. Simply click the link where you're watching this video and book a complimentary appointment with me one-on-one. So let's start with the basics of this gold rally. Why did gold hit record highs? Well, I noticed three main global forces in play here. Firstly, a weakening US dollar. We see it with the South African rand. It's not like the rand is strengthening, it's the dollar that's actually weakening. And gold is priced in dollars. So when the dollar weakens, gold becomes cheaper for those that are buying in foreign currency. And that pushes up global demand. And then there was some interest rate expectations from the US Fed, which is the equivalent of the South African Reserve Bank in the United States. When investors think that the Federal Reserve is going to lower interest rates, they move money into gold. Why? Because gold doesn't generate interest. It gains, or it holds its value. So lower interest rates means less competition from interest-bearing assets. So when interest returns are low, investors tend to move into other asset classes, gold being one of them, or commodities. Then there was global uncertainty, from wars to trade tensions slowing down global growth. Uncertainty makes investors nervous, and nervous investors buy gold. It's a classic flight to safety move. Gold is the safe haven. You probably heard this all the time. But there's one more piece that people often miss, and I'm going to tell you about it. When I create content, it's always from a South African perspective. And if you haven't noticed, I'm of Indian heritage. So I'm going to give you some insight into gold from an Indian heritage perspective. India is the world's second largest consumer of gold after China. About 20 to 25% of the world's demand comes from India alone. In India, gold is not just an investment. It's symbolic of luck, of wealth, and prosperity. Every year, gold demand spikes around Diwali, and it's something that Western economists and analysts don't really pay attention to. So every year around Diwali, when the price of gold spikes, because gold is given as gifts during auspicious times. And it's also wedding season, the start of the wedding season in India as well, after the monsoon, which together roughly accounts for 40%. This time period accounts to about 40% of India's gold demand. So in the weeks leading up to Diwali, Indian jewelers and retailers start buying up large amounts of gold to meet the retail demand. This surge can cause a short-term lift in gold prices, especially when you combine it with a weak dollar and global uncertainty. Historically, September to November, gold prices have shown a modest 2 to 3% increase. I don't believe that's coincidence. So while Western analysts typically focus on the United States and interest rates, even ETF flows. So while Western analysts typically focus on the United States and their interest rates, they tend to overlook the impact of the retail buyer in India during this season. So we had the surge of gold. Why did it suddenly slump? Especially during the Diwali period. Remember that markets run on expectations. Once people realized that the US Federal Reserve might be keeping interest rates higher for longer, the excitement faded. The US dollar strengthened, making gold more expensive for global buyers. As the dollar goes up, gold cools down. And naturally, after such a strong rally, investors start taking profits. That's what I did for me and my clients. We took some of our gold profits and put it into another commodity segment that is super cheap right now. This is just the normal part of the market cycle. No market goes up forever. So what does this all mean for South African investors? When the gold sector is strong, it benefits the mining sector. Remember that we are a major mining country. Well, we once were a major mining country. Companies like Gold Fields Anglo Gold Ashanti and Harmony Gold typically see a rise in profits because gold prices are high, which can lift their share prices in return and support other areas in the JSE. And usually, when the mines do well in South Africa, we find in the next financial year, the tax increases are typically lower because a lot of the national budget has been met from the gold proceeds from the mines. Another key thing that we need to pay attention to as South African retail investors is the rand dollar exchange rate when it comes to gold transactions. If the rand weakens, then the local price of gold actually increases, even when gold price dips. That gives South African investors a very unique cushion. So while global investors might see a little bit volatility, local investors can gain through a weaker currency, combined with a very steady gold demand. So when it comes to identifying opportunities as an investor, here is where you need to be really strategic. Gold remains a very powerful diversifier in your investment portfolio, whether you're holding physical gold, gold ETFs, or even mining shares. It helps balance the portfolio when the markets are topsy-turvy. Now, when markets get volatile, tend to move in the same direction while gold doesn't. It's not tied to company profits, interest rates, or government performance. It's tied to global confidence. While you might be getting profits from the high prices of gold, company profits don't affect the price of gold. So when investors tend to get nervous about inflation, debt, or even stock market crashes, they often move into gold because it's safe. It's a store of value. I like to see it as God's wealth. The Garden of Eden had gold in it before there were any transactions, any shops, any stock markets. It's God's wealth because it's finite. So when other asset classes could be falling, gold can typically rise. Or at the very least, it will hold its value. Think of gold like a shock absorber in your portfolio. If your shares drop 10% and gold goes up 5%, that cushion reduces your overall losses, but steadies your return over time. Now, gold won't replace the growth assets in your portfolio, but it helps smooth the bumps when the markets are very volatile. So what you need to remember as a gold investor, or as a South African investor for that matter, is that gold is negatively correlated to risky assets. It helps protect your wealth in terms of a weakening rand or even market panics. Another thing we have to pay attention to is global central banks, including China, who have been increasing their gold reserves in the last couple of years, moving away from the dollar as a reserve. Over the last couple of months, especially with the trade war that's between the US and China, economic results haven't been fairly smooth from China. It's been up and down, right? Has been affecting the Chinese currency. To stabilize things, the Chinese central bank has been buying massive amounts of gold. And since 2023, the Chinese Reserve Bank has been buying gold consecutively for more than 18 months. Why? Because gold helps China drift away from the US dollar as a reserve and protect against currency weakness. Because remember, gold holds its value. And that demand from China has been a major reason for gold prices rallying, even when Western investors are cautious. Remember the cultural significance of gold in China and India as well. At the same time, while China's been buying up this gold, the Chinese economy has been wobbling. Global investors move their money out of China into gold for stability, especially if they're expecting lower growth from China due to these trade wars. So in short, a weaker Chinese currency means more gold buying from the Chinese Reserve Bank. Equals higher demand equals higher prices. But once the Chinese economic data stabilized a little bit, the Chinese currency stabilized a little bit, some of that gold demand cooled off. And that we can see with the recent dip in gold prices. And us South African investors, we have the benefit of a dual effect here, right? A weak currency and a strong global gold price. Remember, gold is priced in US dollars. So when gold price rises and the rand weakens, South Africans get a double boost in returns. So let's just say, for the sake of my mental maths, gold is trading at $3,500 an ounce. The exchange rate at around 18 rand to the dollar. So $3,500 times 18 rand equals a value of 63,000 rands per ounce of gold. Now a second scenario happens. Gold rallies and the rand weakens. Now gold jumps to $4,000 an ounce. The rand weakens to 19 rand to the dollar. $4,000 times 19 rand. Now gold is 67,000 rand per ounce compared to 63,000 Rand an ounce when the Rand was 1 Rand stronger to the dollar. That's a massive 13,000 Rand gain per ounce. Over 20% in Rand terms, even though gold price only rose by 14% in real terms. So South African investors don't just benefit from high gold prices. We also gain from a weakening Rand to amplify that return. What this means for you is gold ETFs that are listed on the JSE automatically captures both these effects of rising gold prices and the Rand dollar fluctuation. Mining shares often see their profits rise during a gold rally. And for your portfolio as a South African investor, it means that gold is a double layer safety net because it's a two-prong approach with gold. It's gold prices and Rand dollar strength. So the key takeaway from this, I want you to understand, is that when gold prices rise globally and the Rand weakens, South Africans get the best of both worlds. Strong global prices and stronger Rand returns. This is one of the few times when a weak Rand actually works in your favor. Right? But remember, everything is in a cycle. Gold prices are isolated, Rand dollar is isolated. You have to be very careful, very strategic when you make those gold buying moves. One thing you got to know about gold investments, though, that gold doesn't generate interest, right? Like a bond or an income fund. It's for capital preservation. It's for holding its value. Timing matters. Rallies can fade quickly, as we've just saw. And if you invest through ETFs and gold mining shares, you're still exposed to overall market risk. And when the shares, you are impacted by company performance as well. In South Africa is a little bit different. The mining industry is not managed correctly from a government and policy perspective. So the bottom line here is gold is part of your investment strategy and should be part of your investment strategy, but it's not your entire plan. So how do we invest in gold? Before we go any further, here is a quick disclaimer. This video is sponsored by Stock. Although this is a sponsored video, I have full creative control. All opinions, all research, and all insights are completely my own. I'm a fit, proper, and licensed South African financial advisor. And this video is not financial advice, it's for educational purposes only. My goal is to help you understand how gold works and how you should see it as part of your investment strategy. So go and explore them further with your own financial advisor. If you don't have a financial advisor, I will be happy to help you. Click the link where you're watching this video. So the first way you can invest in gold is buy physical coins. I know KZN in Durban, you can walk into any Indian jeweler and probably buy your Kruger Rands. All right, you can even buy other government-backed coins like the Canadian Maple, the American Eagle, the Britannia, those government-backed gold coins. Right, with the Kruger, you can get them in fractions, 1/10, quarter ounce, half an ounce, and 1 ounce. The next thing you can do is buy gold ETFs, and this is where Stock comes in. You can literally go and download the Stock app. It's my preferred app. I love the look and feel of Stock. Right, you can click the link where you're watching this video, or even scan the code on the screen, and you can get your Stock download and explore the gold ETFs that's available to you on this platform. Then there's mining shares, also available on the Stock platform. You also have overseas shares, mining shares available as well, companies that you have to explore. Obviously, you're going to have to do the various analysis, understand the company before you buy those shares. On Stocks, you're able to buy gold mining shares like Anglo Gold Ashanti, Harmony Gold. But you must be aware of the various operational risk that the company is exposed to before you invest in company shares. Any company shares, not just gold. So is it a good time to buy gold? Well, gold is not just about chasing the highs. It's about protection. And how I fit in gold into my client's portfolio is we're buying regularly. Whether the prices are up, whether the prices are down, we're buying regularly. I'm a very big, firm believer in gold. If you're looking at a balanced portfolio, you're looking at 5 to 10% exposure to gold and other commodities as well. Remember, there are other commodity cycles, and one thing that has been in the shadow of gold prices has been platinum prices. Another thing, you want to check my video on silver. Silver prices are cheap compared to gold right now. Remember, silver is not just a precious metal, it's an industrial metal as well. So think long term here. Don't just look at the hype. Don't rush off and just buy gold stocks. You got to sit and come up with a strategy first. And that is something that I will help you do as a financial advisor. So to sum it up, gold rallied in fear, slumped on reality, but still holds value for those of us that understand the role of gold in your investment portfolio. For South Africans, it's not just about timing in the market. Gold should be used as part of a broader strategy in your wealth plan. So if you're ready to buy gold and its various derivatives, check out the Brock Stock app. You can download that. And if you're looking for strategy around gold and other asset classes, click the link where you're watching this video, and I would love to chat with you one-on-one.